Here's what CNBC isn't telling you about the Q1 GDP report. The number came in at a 0.3% decline, and while the headlines might have you thinking we're headed for a recession, there's a lot more to the story. Stick around, because today we're going to break down why the economy isn't as bad off as the GDP suggests. Hi, welcome to Market Policy Watch, where we give you the unfiltered truth behind the economic numbers and how politics, policies, and media narratives shape what we see in the market. Today, we're diving into the latest Q1 GDP report. You've probably heard that it fell by 0.3%, but I'm going to show you why the real economy may not be in as much trouble as the headlines suggest. While CNBC reports that GDP contracted by 0.3% in Q1, don't jump to conclusions. There are several key reasons why this drop isn't necessarily a reflection of a weakening economy. Let's dive into the details and see why we're not in a crisis, despite what the media is saying. Okay, so here's what everyone's talking about. Q1 GDP fell at a 0.3% annualized pace. This is the first time we've seen negative growth since Q1 of 2022, and the media is quick to jump on it as a sign of trouble. But here's the catch: GDP is a broad measure, and it doesn't tell you everything about what's happening in the real economy. Here's a critical point: GDP includes everything: consumer spending, business investments, government spending, exports, and imports. The issue is that negative growth in Q1 is mainly due to one-off factors like reduced government spending and trade imbalances, not a collapse in consumer spending or business activity. Quick refresher: GDP, or Gross Domestic Product, measures the total market value of all final goods and services produced in the US over a year. It's calculated using the formula GDP equals C plus I plus G plus NX, where NX, net exports, equals exports, X, minus imports, M. In Q1, the decline in real GDP was primarily driven by a rise in imports and a reduction in government spending. These drags were partially offset by increases in business investment, consumer spending, and exports. So what does that actually mean? It means companies were aggressively building up inventories in Q1, really stocking up. Trade contributed negatively. Imports were high, and exports were low, meaning we imported more than we sold overseas. That's a trade deficit, and it drags down GDP. But again, this isn't a reflection of long-term economic health, it's part of global supply chain dynamics and international trade issues. While the GDP number is negative, it's important to note that the real economy is not down. For example, consumer spending, which makes up the largest chunk of GDP, remains strong, growing by 3%. This means that people are still buying goods and services, and the economy isn't grinding to a halt. Additionally, business investment was strong in certain sectors. So, while the negative GDP growth may sound concerning, it's not reflective of the overall health of the economy. It's just a small piece of the puzzle. Another key piece that often gets ignored in mainstream coverage is the political influence on the economy. It's not just a matter of weak GDP quarters, policy decisions coming out of Washington have long-term ripple effects. Take stimulus policies, for example. While they helped prop up consumer spending during tough times, they also contributed to persistent inflation, which we're still seeing play out in everyday prices. Meanwhile, the Federal Reserve has kept interest rates elevated since before the election, making borrowing more expensive for both consumers and businesses, without offering much relief. But it's not all downside. One bright spot: the US continues to attract massive investment inflows, signaling long-term confidence in the American economy despite short-term volatility. So what does all this mean for investors? The headlines are doing what they always do, spinning fear. A lot of the media is quick to paint a bleak picture, especially when it lines up with a negative narrative around Trump. Recession odds are rising as Trump's trade war escalates. Wednesday's first quarter GDP report added to fears the US is already in a recession. US economy shrank at start of Trump's second term. U.S. economy shrank 0.3% in the first quarter as Trump policy uncertainty weighed on businesses. Yellen warns U.S. recession risk is way up after Trump's tariffs. Trump downplays recession fears, saying the US would be okay in the long term. But here's what they are not telling you: despite the negative GDP print, the market is moving up. The stock market isn't reacting with panic. In fact, it's showing strength. Why? Because investors are looking beyond the noise. They see strong consumer spending, resilient business activity, and a surge of investment capital flowing into the US. That tells a different story, one of long-term confidence, not collapse. Notice how the S&P 500 initially dropped in reaction to the Q1 GDP data, but then steadily climbed and closed significantly higher by the end of the day. You might have also noticed how the media's narrative started to shift as the market turned around. As Warren Buffett said, leave your emotions at the door when you invest. That's solid advice, especially in a media landscape built on fear and distraction. Here's what President Trump had to say about the Q1 GDP report. His take on the data adds an interesting perspective to the ongoing conversation. Let's take a listen.
How well you were doing in the polls, and then after you were elected, you said the stock market highs were a reflection of how well the transition is going and the American people's confidence in your incoming administration. Now, the stock market's not doing so well, and you're saying that's the Biden stock market, yet you are the president. Can you explain that?
Yeah, I'm not taking credit or discredit for the stock market. I'm just saying that we inherited a mess, both at the borders. You could look at every single one of the people here, and no matter who it is, they're doing better, and they are far superior to what took place for 4 years before us. Look at what happened with inflation. We had the worst inflation probably in the history of our country. They say 48 years, but I would say in the history of our country, it ate away at people. And even though you saw a stock market going up somewhat, because in my case, I had the biggest stock market increase, 88% in the last term, in my last term. But I don't view the stock market as the end all. It's an indicator. But what the stock market really tells you, and when you look at the stock market in this case, is it says how bad a situation we inherited. This was a quarter that we looked at today, and we took all of us together. We came in on January 20th. So this is Biden, and you could even say the next quarter is sort of Biden, because it doesn't just happen on a daily or an hourly basis. But we're turning it around. It's a big ship to turn around, and we're going to have the greatest country financially in the history of the world, I believe. I think we're going to do things and we had to do it. We reset the table.
Here's the takeaway. While the GDP report might show a 0.3% contraction, the real economy is still moving forward, albeit at a slower pace. So, if you're worried about a market crash, don't panic. Instead, take a closer look at the fundamental data, the job market, consumer spending, and investment trends. Ultimately, a 0.3% drop in GDP doesn't mean the economy is in a recession, it just means there are some temporary factors at play. Consumer spending is still strong, and business investments haven't collapsed. The media is quick to jump to conclusions, but here at Market Policy Watch, we're looking at the bigger picture. Thanks for watching. If you found this video insightful, make sure to subscribe, like, and hit the notification bell so you don't miss any of our upcoming deep dives. Let me know in the comments, do you think the economy is in a downturn, or is the media blowing things out of proportion? See you next time, where we'll continue to uncover the truths behind the numbers that move the market.